Another method that is more commonly used and probably arguably a little bit more accurate is what's referred to as the effective interest rate. And the effective interest method is the most theoretically correct method. It recognizes time value of money on interest expense. And interest expense is different each period. And the steps determine the exact price at the issuance. And so we then develop an amortization table. We do that at the beginning when the bond is issued, so that from after that first time, all we have to do is go look at the table and we know exactly what we have to compute. So let's take a look. An example here. We have an issue date of January 1st, 2018. Seems like it's the same date every time. It matures on January 1st, 2023, same deal. Face value is 100,000. The stated rate is 9%. With the par value and the stated rate, we can compute what the payment's supposed to be, 100,000 times 9%, which normally would be $9,000, but because we pay payments semi-annually, we're going to multiply that by 6/12, and that means that our interest payment will be $4,500. The payment dates are January 1st and July 1st. Maturity date, we already talked about that, January 1st, 2023. Market interest rate at the time of the issue is 10%. These are 9% bonds, so therefore the general market rate is higher than the stated rate, so therefore the bonds are sold at a discount, and that means that their discount is $96,149. Okay, so we're going to create an amortization table. I'll go ahead and do it manually. So on January 1st, we're simply going to fill in the information we need. We know that the discount that will be recognized is the difference between the face value of $100,000 or the par value of $100,000 minus the issuance price, which ends up being $3,851. And then to come up with the bond carrying value, we're simply going to take 100,000 and we're going to subtract from that the balance in the discount account. So the bond carrying value is computed by taking $100,000 minus E. So when we have the amortization table we need, we'll go ahead and label it out. This is exactly the way it's set up on the PowerPoint. The first line on the date of issuance, we're going to simply list the carrying value. And the way we compute that carrying value is we identify how much is our discount account balance. Well, since we just issued it on this date, then it's going to be the full discount. Now, how do we come up with the discount? We're selling it for $96,149. Its par value is $100,000. The difference is going to be the discount. In this case, it's $3,851. So 3,851. And the way then we compute the carrying value, which we really should know because we just used it, but we're going to take 100,000 and we're going to subtract the discount. So our carrying value is going to be $96,149. Every payment period, we're going to recompute the amount of interest. And like I mentioned before, it's going to be changing every period. But what doesn't change is going to be the actual payment amount. So this first column, this is column B, is the same every time. In fact, I'm going to compute it once and I'm just going to continue to list it there. So to compute the interest payment, we use, now we know it's 9%, 0.09, right? We know it's 9%, but we also know that there's semi-annual payments. So another way of doing this is we just divide the interest rate by 2, and we come up with 0.045. So every interest payment is going to be 0.045 because this is a 9% stated interest rate. If it were a 10% stated interest rate paid semi-annually, then the rate we would use would be 5% or 0.05. Now that we know how we came up with the 0.05, we take the 0.05 plus 0.045 and we're going to multiply it by the maturity value. Well, the maturity value is the bond carrying value. Well, the maturity value in this case is $100,000. Every payment is going to be $4,500. 0.045 multiplied by $100,000. So the payment's going to be the same every time. I might as well just carry that all the way down. The payments are locked in stone. They don't change. We are good to go. Now the interest rate is going to be computed by taking 5% and multiplying it by the preceding bond carrying value. Now, where did we get the 5%? We're told that the market interest rate is 10%. See that? Market interest rate is 10%. But because these are semi-annual payments, we're going to use the market interest rate to compute the interest expense. But because these are paid semi-annually, then the 10% is an annual rate, we have to divide it by 2. Well, 10% divided by 2 gives us 5%. So the market rate is 5%, and we're going to use that 0.05, and we're going to multiply it times the bond carrying value from the previous row or the preceding bond carrying value. So in other words, since we're here, we're going to go up. That's what is the carrying value. We'll take 0.05 and we'll multiply it by the carrying value of $96,149. So that's going to give us $4,807 for the first payment that's due 7/1/2018. The discount can be computed by taking column C and subtracting column B. So let's do that. Column C minus column B, which really means is the difference between the payment and the interest expense is going to be the amount to be amortized. When we say amortized, we mean that that's the amount that's going to be lowering the actual discount. So now, in order for us to come up with our new balance of our discount balance, we're going to take the preceding balance and subtract column D. So now our new balance at 7/1/18 will be $3,544. And then we can update our carrying value by simply taking 100,000 and subtracting the discount, which is lower than it was before. So you're seeing that the bond carrying value will be increasing. I'll do one more. The payments are all the same, always the same. The interest is going to be computed by taking 0.05 and multiplying it by the preceding bond carrying value, which is $96,456. $96,456 multiplied by 0.05 gives us $48.23. We'll compute the discount by taking the difference between the interest expense amount we just computed and the payment. And that difference is $323. From there, we're going to take the preceding amount of $3,544, subtract the discount of $323, which gives us an updated balance after the payment on 1/1/19 of $3,221. From here, we're going to take our bond carrying value and adjust it by taking 100,000 minus column E, 3,221. Now from here, if you understand Excel, which you probably don't, maybe you do, from here we'll just copy it down. So we have the amortization schedule. The issuance was on January 1st, 2018, and the final payment date will be on 1/1/2023. We first compute or start off with computing the discount and the bond carrying value. We can go back to the description here. It tells us that the face value or the par value was 100,000, but we sold it at 96,149. So the discount is going to be the difference between the two. That discount is going to be 3,851. So 3,851 will be here. And the way we compute the bond carrying value is we take $100,000 minus column E, the discount. So 100 minus the discount. Moving on to the very first payment, we compute what the payment's going to be. In the column here, it says take 0.045 and multiply it by the maturity value. Well, the reason why we come up with 0.045 is because the stated interest rate is 9%, but the payments are made semi-annually, so we're gonna divide that by 2. And when we divide it by 2, you end up with 4.5% semi-annually. Plus 0.045 multiplied by the maturity value, which is 100,000. And this payment is going to be the same every period. That's locked in stone. There's no way you can change this. 100,000. The interest rate is going to change every period. The way we compute the interest rate is we take 0.05 and multiply it by the preceding bond carrying value. Well, in this case, when we say the preceding, we're in this one, so we're going to look at the previous row. It's 96,149. And the reason why we're multiplying it by 0.05 is we look at the instructions. It tells us that the market interest rate was 10%. So if this was an annual program, then we would be using 10%, but it's paid semi-annually. So we're going to take that 10% and we're going to divide it by 2, which means it'll be 5% semi-annually. So 0.05 multiplied by the preceding bond carrying value. That's going to give us 4807. To compute the actual discount amortization, we're simply going to take C minus B. That gives us 307. To update the balance on our discount, we're going to take 3851, which is in column E, and we're going to subtract 307 in column D. But it's the preceding balance, so it's this minus this. And that gives us an updated balance of 3,544. And then the bond carrying value is going to be the same computation. It's going to be 100,000 minus E. But because E is smaller now, then the carrying value is going to increase. The interest payment for the next period is going to be the same, $4,500. The interest expense, same computation. We're going to take $96,456. That's the preceding bond carrying value, and we're going to multiply it by 0.05. That comes up with $4,823. The discount is going to be computed the same, C minus B. That gives us 323. The discount balance is going to be the preceding E minus D. So that's going to give us $3,221. And the bond carrying value is going to be $96,779. That's $100,000 minus column E. And from here, I'm just going to copy it down. No sense in me repeating. Now, what we'll notice is that in the last payment, for the last payment, we'd have the bond carrying value of $99,359. So at the end, we noticed that we didn't come out quite right. So we know that that's going to have to be forced because it's not perfect. We know that before the last payment, we have $99,539. We also know that our discount is $461. So in order for this to work perfectly, we need our discount to be 0. For our discount to be 0, our discount amortization has to be equal to the preceding balance. So in other words, this has to be 461. If you think about it, if your previous balance is 461 and we subtract the 461, we end up with 0. And then we end up with a bond carrying value of exactly what we want. We want it to be the maturity value or the par value. So everything seems fine, except now we need to know how much interest we are recognizing. To make this all work, we're just going to take the interest payment of $4,500 and add to it the 461. So this really, 461 really becomes a plug. And we have to plug the number because the amortization isn't perfect. All right, so now we know how this was derived. Take a look at our accounting for bonds. you'll see this is the same information we had earlier. You'll see that our bond carrying value started at $96,149. That was the issuance. But by the time we finished, or when we finish making that last payment, the carrying value will be its par value, which was $100,000. So let's note here, column B is fixed. It's fixed by contract. That's written in the bond indenture. That's the details to the contract. You can't modify the payment. Well, because you can't modify the interest rate, the stated rate can't be modified, and the par value can't be modified. So that's fixed. The payment is fixed. It will not be changed. Interest will adjust based upon the carrying value. So the interest expense increases as the discount bond approaches maturity. You can see how it's going up, 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 up and away. So the slide shows how we computed it, although I showed you on the spreadsheet. I showed you how to compute the discount amortization. And you can see, just like we saw on the spreadsheet, the discount balance decreases when it's amortized. And we can see the impact of the carrying value and how it increases every payment. So here's a graph that shows the amount of interest payment that is paid, but also shows how the interest expense increases every payment from 4807 to 4961. This graph shows how amortizing the discount on bonds payable, the bond face value is at 100,000. The discount started at 96,149, and over the life of the bond, the carrying value just kept going up and going up and going up until maturity date, which was in 10 years. I'm sorry, in 10 periods. Maturity date, it essentially now is, the bond carrying value is the maturity value. Okay, so now that we know how to do the effective interest rate amortization, now we can use that. We can use the table to record our journal entries. The way we're going to record our first payment, which is due on July 1st, 2018, is we're going to record interest expense. Well, where does that come from? Well, we'll look at our table. What's the interest expense amount? For July 1st, 2018, the amount of interest expense is $4,807. Bingo. That's what we're booking as interest expense for the journal entry. We're going to credit discount on bond payable. Well, the straight line, it was equal every time, but now we know that's not the case. On the July 1st payment, let's look up what the discount on bond payable is. The discount amortization, $307. Boom, there it is, $307. We'll take the difference between these two, and we're going to come up with a cash amount of $4,500, which is what exactly we showed here, $4,500. On December 31st, we're not going to pay it because the payment isn't due until January 1st. We did this before, right? We're not going to pay it, but we do have to accrue for it because at year end, it's December, we have to accrue for the interest. So the interest expense we're going to recognize is $4,823. This is on December 31st, 18. $4,823. Where does that come from? Well, this is coming from the January 1st amount. See, we're going to pay it on January 1st, but on December 31st, we'll go ahead and recognize $4,823. The interest expense. There's the debit. The credit is going to be to discount on bond payable, $323, $323. If we had paid it, the credit would be cash, but it's not going to be because we're not paying it on December 31st. We're going to pay it on January 1st. So instead of paying it on December 31st, we're going to recognize interest payable of $4,500. That's the payment. That's what we're going to pay the next day. On the next slide, it goes on to talk about how you would deal with a premium under the effective interest rate amortization. And it's going to be really the same process, except instead of dealing with a discount, like we just went through the process with the discount, you would go to the same process on a premium. So on January 1st, 2018, Southwest issued $100,000 9% 5-year bonds when the market interest rate was at 8%. The interest rates go down or below the stated rate, the price will go up. So in this case, the issue price is at $104,100. We're going to record the issuance just like we had done before. Cash coming in is $104,100. Bond payable is going to be credited at the par value of $100,000. The premium, however, is going to be recognized as a liability or an additional liability premium on bond debt payable for $4,100. So the balance sheet is going to be shown as a bond payable, that's a face value, and then a premium on bond payable, which will increase the amount of the liability so that the carrying value is actually higher than the bond payable. So we're going to have a similar amortization table, but immediately we can see the difference. A premium is going to be computed as $4,100, which is the difference, let's go back, the difference between the price and the par value. The par value being $100,000, the price being $104,100, the difference is $4,100. So that's going to be the premium. You can see right here, the premium on the bond is $4,100. So that's what we're going to start off with. $4,100 is the premium, and the bond carrying value is going to be computed by taking $100,000 plus the premium. So when we first issued this bond, our carrying value is going to be $104,100. Now the interest payment is going to be the same because the terms, what are the terms? The terms call for 9%. So this is exactly in terms of the payment, the same circumstances. The difference is that this was sold when the market rates were lower, so that means we ended up with a premium. Therefore, when we compute the interest now, we're not going to be using 5% as we did before. We're going to be using 4%. Where does 4% come from? It comes from 8% divided by 2 because it's semi-annual. 8% is the annual interest rate divided by 2. So the market rate is going to dictate this. 8% divided by 2 is 4%, so we have 4%. So we're going to take the preceding carrying value, which in this case is $104,100. We're going to multiply it by 0.04, and we're going to end up with $4,164. For the premium, we're going to take column B minus column C, which is $336. Update the discount balance. We're going to reduce the discount balance by the premium amortization, and then we're going to update our carrying value. We can do this one more time. 103,764 multiplied by 0.04 will give us 4151. Premium 349. Carrying value 3415. The premium balance 3415, and the bond carrying value 103,415. From here we should be able to copy down the formulas so that on the payment before the last payment our balance is $100,545. So what we know is we want our premium to be 0. For it to be 0, the amortization would have to be 544. And so for this to occur, we need to take the interest payment and subtract 544, 3956, and that's going to be a plug, just like we did before. Now, my numbers are a little different than than the slide, but that's obviously because of some rounding errors. So if I take this, I end up with 100,000. Where did I get off? 727451. Oh, right after 415. So it looks like from here down, rounding was off. I think my numbers are actually a little bit more accurate because they probably had a calculator to just do one row at a time, or close enough. We ended up with the final carrying value. Okay, looking back at our slide, this is the amortization table. Again, it looks like just we started to have a difference right about here. This is the carrying value at 104. That's what we started off with, 104, 100. And then the carrying value is going to slowly reduce to 100,000 when it matures. This is your amount of your payment. That's fixed. It never changes. The interest expense computes or decreases as the bond carrying value decreases. We figured out how to compute the interest expense and the premium amortization, the premium balances, and the bond carrying value. So now when we're ready to record the payment on July 1st, 2018, the first question we have is, well, how much interest expense do we need to record? Well, let's go to July, well, I'll just use mine. So let's go to the July 18, the amount of interest expense we computed, 4164. Bingo, 4164. The cash we're going to pay is 4,500. That's what's shown here. The difference is the premium, 336, 336. So we don't have to do anything but look at, once we've got it all computed on the table, we just follow the table, and let's use that to then record all the journal entries from then on. Okay, we have a graph showing how the interest payments remain the same. And in this case, the interest payments will actually go down over time. And this graph shows how the bond carrying value of 100,000 is aligned, and how the bond premium over time, the balance will go down and down and down until the maturity date, when it will be zero, so that bond carrying value equals the maturity value.